Your mortgage rate is 6.5% right now. You probably blame the bank, or the Fed, or inflation. None of them said it. There is a $145 trillion market most Americans have never once looked at. No app sends you alerts from it, no news anchor explains it every night. And yet, it decided your mortgage rate this morning. It controls the interest on your car loan, and in 2022, it quietly erased 16% of millions of retirement accounts, the part people believed with faith. That market is the bond market. By the end of this video, you will understand exactly how it works and how much money it is costing you in real dollars right now. A bond is a loan. A government, a city, or a company needs money. Instead of going to a bank, they borrow directly from investors, from people like you. You hand over cash called the principal. They make two promises: a fixed interest payment every year, called the coupon, and your full principal back on a specific end date, called the maturity. That is the entire instrument. But here is the one rule that explains every disaster, every retirement loss, and every mortgage rate in this video. When interest rates rise, the price of existing bonds falls. When rates fall, prices rise. Always, every time, without a single exception. Here's why. You buy a $1,000 bond paying 3%. It sends you $30 a year. 6 months later, new bonds come out paying 5%, which is $50 a year for the same $1,000. Now you want to sell your bond. Nobody will pay $1,000 for it when the new ones pay more. The only way to sell is to drop your price all the way down to about $600 until your $30 payment looks competitive again. You have not lost a single future payment. The bond still pays $30 a year and returns $1,000 at maturity. But on paper, your $1,000 is now worth $600. Hold that rule. Everything that follows is just that rule operating at a larger scale. Now meet Marcus. Marcus is 34. He earns $72,000 a year. He has been saving for a home for 4 years, and this month he is ready. $400,000, 30-year fixed. When Marcus walks into his bank, the loan officer does not invent his rate. She looks at one number, the 10-year U.S. Treasury yield. Right now, it sits at 4.5%. And she asks herself one question: why would this bank lend money to Marcus for 30 years when the U.S. government pays 4.5% risk-free for 10? The answer is it would not, unless Marcus pays more. So she takes the 10-year Treasury and adds roughly 2 percentage points to cover the risk that Marcus might lose his job, get sick, or default. That math produces a mortgage rate of 6.52%. At 6.52%, Marcus's monthly payment is $2,534. Now the bond market moves. The 10-year U.S. Treasury rises by half a point, a routine move completed in a single trading week without making a single headline. Marcus's rate climbs to 7.02%. His new payment is $2,667. That is $133 more every month for 360 months. That half-point move in a market Marcus has never visited costs him $47,898 over the life of his loan. A full 1-point rise, also routine, pushes his rate to 7.52% and his payment to $2,802. Over 30 years, that is $96,696. Now run his same $400,000 loan through two real historical rates. January 2021, the 30-year fixed hit an all-time low of 2.65%. Marcus pays $1,612. October 2023, the same rate peaked at 7.79%. Marcus pays $2,877. Same loan, same house, same buyer. The only thing that changed was the yield on a government bond Marcus has never purchased. The difference is $1,265 a month. Over 30 years, that is $455,349. The bond market handed Marcus a $500,000 bill and never sent him an invoice. For decades, every financial advisor gave anyone approaching retirement the same advice:
As you get older, move out of stocks and into bonds. Stocks grow your money, bonds protect it. The classic 60-40 portfolio, 60% stocks, 40% bonds, became the default for conservative investors. The bond half was sold as the seatbelt. In 2022, the Federal Reserve raised interest rates faster than at any point in 40 years, from near zero to over 4% in 9 months. Apply the rule. When rates rise sharply, existing bond prices fall sharply. The broad U.S. bond market lost 13% in 2022, the worst calendar year in the index's history going back to 1976. The S&P 500 fell 18.1% the same year. A 60-40 portfolio, the conservative default, lost about 16%. The seatbelt did not catch anyone. It was attached to the same crash. The reason? Rising interest rates are poison to both stocks and bonds simultaneously. The hedge only works when they move in opposite directions. In 2022, they moved together, straight down. There is one number that explains why some investors lost twice as much as others. It is called duration. Duration is printed on every bond fund's fact sheet. Most investors have never looked at it. It tells you roughly how much your bond fund will lose for every 1 percentage point rise in rates. Consider a retiree with $500,000 in what she believes is a safe bond fund. Duration of 6, typical for a broad bond index. A 1-point rise costs her $30,000. Duration of 17, typical for a long-dated Treasury fund, the same 1-point rise costs her $85,000. Same woman, same $500,000, same rate move, $55,000 difference. The only variable is a number on a document she was never told to read. Duration is the difference between a bruise and a broken leg. Most people who own bond funds have no idea what their number is. They were told bonds are safe and stopped reading right there.
3 things to do right now. Number 1, look up the 10-year Treasury yield right now. When it rises, mortgages, car loans, and business borrowing rise with it. When it drops sharply, the bond market is signaling that a slowdown is coming. It is the closest thing the economy has to a check engine light, and now you know how to read it. Number 2, if you own any bond fund, find its duration on the fund's fact sheet today. Anything above 7 means your fund moves meaningfully when rates do. Anything above 15 means your so-called safe investment will behave more like a volatile stock than a seatbelt. That number is not optional. It is the number. Number 3, check where your cash is sitting. The national average savings account at a major U.S. bank pays 0.38% today. A 3-month U.S. Treasury bill pays 3.71%. Both are equally safe. Same protection, dramatically different return. On Marcus's $50,000 in savings, his bank account earns $190 a year. The same $50,000 in T-bills earns $1,855. That is 9.8 times more money for identical risk. Over 5 years, leaving it at the bank silently cost Marcus $8,325 in interest he could have collected without taking on a single dollar of additional risk. The bond market is not something wealthy people do in their spare time. It is the invisible machine that priced Marcus's mortgage this morning, set the return on your savings account tonight, and determined how much of your retirement portfolio disappeared in 2022. Every dollar in your financial life is touched by it. The people who understand how it works are not smarter than you. They just stop pretending it was boring. If this connected something for you, hit like, subscribe to keep doing the math, and I will see you in the next one.